Hi, this is Brooks Kelly, and today we're talking about jumbo mortgage loans. And what is a jumbo loan, and what is the difference between getting a jumbo versus a conforming conventional loan? I'm going to break it all down for you in this video. We're going to go through a bunch of different parameters, I would say, or different regulations that go around jumbo. But the biggest difference between a jumbo and a conventional loan is a jumbo is anything that's over the conforming loan limit. Conforming loan means conventional, and every year the conforming loan limit goes up, or almost every year. In recent years, it's gone up exponentially. When I got in this mortgage business 17 years ago, I think the conforming loan limit was $390,000. This year it's $766,000, and I think it's going to 802 or approximately around that for 2025. So a jumbo is anything that's $1 more than that or higher. And always jumbos are not a mainstream loan, meaning that they're not sold on the secondary market. So they can't be packaged together with a bunch of other loans like a Fannie Mae or a Freddie Mac or an FHA loan. They can't be packaged together and sold. They're individually held by each private bank or mortgage company that's doing them. So every single jumbo has different guidelines that go with it. From bank to bank, from credit union to credit union, they're all different. And they have different regulations and different underwriting guidelines that they have to go by in order to meet their specific underwriting guidelines. So we're going to go through all of that. I'm not going to touch on every single jumbo lender out there because that's not possible. But I have done hundreds of these loans in my career. And so we're going to talk about that from start to finish. So my name is Brooks Kelly. I'm with the Mortgage Link. I'm a mortgage lender. I've been a lender for 17 years. I've funded over 2,000 home loans for folks over the years. I'm one of the top originators in the country. I've been in the Scotsman's Guide top 1% 10 years in a row. D Magazine's best lender 12 times. Texas Monthly 5-star lender. So lots of accolades, just giving you a little bit of credibility on what I'm talking about today. So jumbo loans are becoming more and more mainstream and happening more often as home prices go up over the whole country. And there's lots of areas in the country that are also what we call high balance loans. So like I said in the very beginning, we have the conforming loan limits, and those are set by the FHFA, or the Federal Home Financing Association. And they set these based on a certain calculation off of the average purchase price of homes over the course of the last year. And so these amounts go up over time. But there are areas in the country that are what we call high cost. Think New York City, LA, just big metropolitan areas where home prices are more expensive than they are, say, even in Dallas, where we don't have the high balance area, which I think we should and possibly might in the coming years in certain areas. There's areas like Nashville, Tennessee, which in the Franklin County area is high balance, but then you go outside of that and that kind of goes away. So the high balance areas allow you to get a high balance conforming loan that go by the conforming loan limit guidelines. So they're still technically conventional loans. They can be sold to Fannie Mae or Freddie Mac and securitized with those loans. So this goes outside of that box a little bit, and every high balance area has different limits. And so you can look those up online and find out which one of those fits in your area if that's possible. Now, we're going to talk strictly off of the Dallas area and the normal conforming loan limit. Today, 766, 550 is that maximum. So if you go below that 766, 550 loan amount, you can get a conventional loan, 3% down, 5%, 10% down, and go by all the conventional conforming guidelines. And I'm giving you this information so you can relate it to the jumbo. On conventional, these loans are automated underwriting only. So they go through what's called desktop underwriter, or Freddie Mac's product, which is called LP. And they go through these, and you can essentially do any loan that meets those guidelines that you get an automated approval. And you can go up to higher debt to income ratios because you have that automated approval. You can go up to 50% of your gross monthly income when you're going through this if the system approves it. There's also relief for documentation when it comes to pay stubs, W-2s, written VOEs. Like, there's a lot of relief that come with the conventional loans. Now, relating this to a jumbo is very different because jumbo is not automated approval. And because it's not in an automated approval scenario, you have to conform to the qualified mortgage, which is a 43% debt to income ratio. You have to show the ability to repay with a 43% debt to income ratio. It's hard and fast, it's manually calculated, and like I said, every investor requires different documentation. There's always the standard documents that come with it, but they may ask for more and more and more. Any of you who have ever done a jumbo loan may notice that, where it's just a continuous waterfall of documentation. Once one door opens, then that door just keeps opening and you keep having to generate more documents that go with it, especially self-employed borrowers who have different schedules on their tax returns with royalties or farm income or anything like that. It just continues to open a door of more documentation that needs to go. So why I say that is because they're very stringent on their guidelines, and the mainstream jumbo lenders these days, and the ones that tend to do most of the loans that we sell to, are Citi, Chase, it used to be Wells Fargo, but Truist. There's lots of the big banks, and then there's some credit unions. Every single one of them has their own specific set of guidelines, and they all have their hot buttons. With Chase, you might see specific guidelines on credit depth and not having late payments in the last couple of years. Or you might see a more stringent debt to income ratio with Citi once you go over $1 million. So you have to have a loan officer that knows exactly what they're doing and how to navigate these different investor guidelines, because they change with every single movement in the purchase price or the loan amount or the debt to income ratio or the assets. You know, some require you to have your own assets, some allow you to have gift fund assets. And so you have to make sure that each one of your specific scenarios fits with that specific investor. And sometimes you may have to go with a different investor that may not have the best possible rate in order to get your scenario to fit within the guidelines there. So next we're going to talk about the properties that are eligible. You can get a jumbo loan for a primary residence, a second home, or an investment property. The further down that list you go to second home and investment property, the more likely is you're going to have to put a bigger down payment down. It's just a riskier loan, and so the guidelines are going to change to where if you get to the investment property for a jumbo, it's a fairly risky loan, and they're going to want you to put at least 20 or 25% down. So let's take that and move into the loan to value ratios that you're going to see on a primary residence. So most jumbo investors are going to require you to put at least 20% down when you're purchasing a primary residence. There's some that do 15% and some that only do 10, but when you see a loan that doesn't have the 20% requirement, you're also going to see an adjustment in the rate at 85% and at 90% loan to value. You're also going to see a requirement for more reserves in the bank, which reserves are payment money left over after the transaction's closed in order to make your mortgage payment in case something happens down the road. So the reserve requirement goes up, so does the interest rate, because most jumbo loans don't have mortgage insurance. Very seldom do you actually see mortgage insurance on a jumbo. They just take the risk and they increase the rate in order to cover their risk on the loan. They also underwrite it with more stringent guidelines. A lot of times when you're at 85 or 90%, you're going to see your ratios go down. So your DTI will go from 43 to maybe 38 or even 35 in some scenarios. Keep that in mind when you're shopping for a property over that conforming limit. And there could be other solutions to go by. Instead of doing jumbo, you can do a combo loan as well, where you do a conforming first lien and then a second lien to cover the difference. Next, I'm going to talk about credit score, because all loans are based on credit and what your FICO scores are, but no loan is more stringent about that fact than a jumbo is. Jumbo wants to see the A+, A perfect borrower that's got 760, 780 credit scores. They will loan to borrowers that have 720, 700, in some instances 680 or 660. But like I was talking about before, the risk factor goes up, the interest rate goes up, and probably the debt to income ratio allowable goes down. The riskier the loan, the more stringent they're going to be. And these guidelines change based on every single borrower and what their parameters are. So with credit, it's not just the credit score. They're going to look at credit depth. Not just did you establish credit in the last 6 or 12 months. They're also going to see, okay, do you have 3 credit lines that have been open for 12 months and have a perfect payment history? Have you had mortgage lates in the last year or two? That's a big factor on a jumbo. They're going to look really, really deeply because they can't go off the automated approval that a conventional loan gives you, and they're going to be very strict on what their guidelines are. In some cases, you can get exceptions, but I haven't seen many cases where you can get multiple exceptions. So if you had to get an exception for, a late payment on a mortgage, you're not going to get an exception for something else down the road that may come up on the file. So they're going to be very strict when it comes to that. All right, down payment. We already talked about the loan to value ratio, which is, essentially what the down payment is, but I want to talk about where the down payments can come from and where the assets can come from too. So we're talking about an 80 LTV loan. That means your down payment is 20% down. In almost every case, they're going to want the borrower to have at least 5% of their own funds to apply towards their down payment. So they could get a gift for a family member if they wanted to, but the borrower's got to have some of their own skin in the game. I feel like that's a very important risk factor when it goes into these high dollar loans. In some instances, and you could see this come up in the coming year, if real estate prices decline in some areas, we've already seen this in areas like Austin, Texas, some areas of Florida, called a declining market. Jumbo investors are the first one to go to this and watch the markets as they decline and require more down payment. So if you were doing a jumbo in Austin today, you would have to put 5% more down than what the guidelines say in order to conform to the declining market policy. That's part of your overall down payment and part of the assets that you have to bring to get the mortgage. Next is qualifiable assets. A lot of times we have self-employed borrowers that come to us with a lot of funds in their business account. Are these qualifiable? Well, yes, they are. They're going to ask for a lot more documentation and probably your bookkeeper or CPA to certify that it's okay to take this amount of money out of the business in order to utilize it for the down payment of the home. Any other assets qualify just like any other loan: checking, savings, IRAs, 401ks. You can use stocks and bonds. You're going to have to show the liquidation of those assets, but they're going to have to be yours, and you're going to have to show the movement of those from the time you sell the asset until the time that you move it into the account that you're ultimately going to use for your down payment. They're going to look at these assets and make sure that you have enough money after closing in order to have reserves. Now, I talked about this earlier, but reserves is the amount of money you need after the transaction in order to satisfy the investor requirements. Depending on your down payment, you're going to have a different amount of reserves required. Typically, it's about 6 months of your overall PITI payment: principal, interest, taxes, and insurance. But if you put less money down, then the reserve requirements go up. In some cases, like on a 10% down, most of the time, they're going to want to see 18 months of reserves in the bank. So if your payment's $10,000 a month, you're going to have an additional $180,000 in the bank. The good news is you don't have to move that money anywhere. You don't have to take it and put it in their account. We just have to verify that it's yours, it's in your account, and it's usable in case you need it. So the next topic is appraisal. The bigger the home price, the more stringent they're going to be, right? And so typically you only need one appraisal on a property. But if the property goes over $2 million, in most cases, you're going to need 2 appraisals. The reason for this is, yes, independent appraisers are independent and they're giving their independent value. But 17 years in this business, I know I can get 2 appraisals from 2 different appraisers and they're going to have 2 completely different values. They're not going to be way off, but they could be $30, $40, $50, $100,000 off. Again, each investor is different. Some are at $3 million, they require 2 appraisals, but it's usually based on the loan amount. So if you get over that $2 million amount, typically you're going to have that requirement as well. And on top of that, you're usually going to have some sort of review process or automated valuation model where it goes in and it also looks at it, or it checks the appraisal to make sure the validity of it is good. Now, jumbo, I would say, is probably the most common loan to have some exotic feature to it. Whether exotic is not really crazy, but it's different than most mainstream loans. Like, very often you'll see jumbo loans offering an interest-only option, which is good in a lot of cases. It gives you a lower monthly payment. Typically, these are done by higher net worth individuals who get bonuses and things like that, who tend to pay their house down later on, or they're not worried about paying their house down and they're using their money to invest in something else. They also have different ARM programs or adjustable rate mortgages with 3-year, 5-year, 7-year terms of where the interest rate's fixed, and then it'll start to adjust later on. Typically on an ARM loan, you're going to see interest rates lower than what you'll see on a 30-year fixed. And so when you're talking about financing $1 million or $2 million and you can save 0.5% or 0.75% on the rate, that's a big number. And so they'll opt to do the ARM and then just refinance it down the road, or they don't plan on being there for a long period of time and they'll sell it within that 5-year or 7-year period. Right now, the spreads aren't super great on an ARM, so you're not going to see a big difference between a 30-year fixed and a 7 or 5-year ARM. You'll see a little bit of a difference, but as the market continues to normalize, you'll see some options with this that will make more sense in a lot of cases for consumers to use an ARM on a jumbo rather than a 30-year fixed mortgage. In conclusion, jumbo loans are a necessary product for this market to function. While there's different options available and you may not need a jumbo even if you're purchasing in that higher market, that's something to consult with your loan officer about and make sure that you're in the right product. Remember, they come with more stringent requirements, a lot more documentation, lower debt to income ratios, higher LTV standards, bigger down payments, more money in the bank for reserves, and just overall, just a finer tooth comb that's looking into this loan and all the documentation provided. So just remember that when you're applying for one of these loans, it's going to be a little bit more difficult. So just know when your loan officer asks you for those documents, there's a reason behind it. For more information or more assistance, please reach out to me and my team. We're here to help you at any time. If you want to learn more about mortgages and things that go into them, please follow my YouTube page, click the subscribe down below. Make sure you like it, and the comments help significantly. Have a great day. We'll see you next time.